After a brutal down day on Thursday, the market rocketed higher on Friday's trading session. Initially, it rose because of the jobs numbers. Then it rose even higher after Powell said that they will be cautious about rate hikes. But the algorithms are thinking too short term and will of course punish the markets in the longer term. Let's get into it. You came here for the truth, so let me unveil that for you. Today we're going to look at what happened in the markets. I'm going to tell you why they rose. We're going to look at the jobs numbers. I want to look at the conference that took place where Jerome Powell, Ben Bernanke, and Janet Yellen all had a chance to speak, and I'm going to show you the data from the mainstream media, as well as the notes that I personally took. Let's begin by taking a look at the markets. You are seeing the stock markets right now. The top three are S&P 500, NASDAQ, and the Dow Jones, all right now in positive territory. The Dow Jones in the middle of the trading session on Friday is looking like it's 816 points higher. This could certainly be 1,000 points by the end of the day. It wouldn't surprise me. Now, what has happened to make such a rise in the markets become a possibility? We had to have some huge information, right? Well, not really. So basically just wanted to finish off with this, showing you what has happened after yesterday's trading session, which was down 660 points. Now you have the Dow Jones rocketing higher, erasing all of the losses and going beyond that. So this just gives us an idea where we are at this time. This information came out in order to initially start this rise in the markets. December jobs report shows surprising strength. You're looking at 312,000 jobs that were created. It's so wonderful. And of course, if you look every single month, the jobs numbers are incredible. Every single month. Now, does that mean that there are more and more employed people? Well, depends on the statistics you look at. If you are actually, truthfully, unobjectively looking at the information, you're going to get a different perspective than what the mainstream provides. So I will show you the chart that goes along with that. December employment change by age group. You are seeing that the group of 20 to 24 years old, as well as 25 to 54, were actually in the negative during December. The group that obviously benefited here in December has been 55 years and over. That is primarily where all the jobs have been created. When you look at these statistics, what is often not understood is that many of the jobs that are created are temporary. So every single month, people are let go and they're rehired, let go and they're rehired. And this process here, every time, it counts as a job being created. That manipulates the statistics, but they can put it out every month, and every single time the stock market rises as a result, because it's just computer algorithms trading on the information. They're pre-programmed to use that data and trade accordingly. That's what is happening today. You're seeing this at a time when we have near record low unemployment rates. But these unemployment rates, how exactly are they manipulated? Are they truthful? No, that's not the case. What you're looking at right here is a video I had done previously, which only has 13,000 views, which is hilarious because this is the data that most people need to understand. And yet maybe it's not cool enough, maybe it's not trendy enough, and that's why it only gets 13,000 views. But if you want to know exactly why the unemployment rate is fake, all you got to do is search the Money GPS unemployment and you will find this video. I break it all down in here. I'm very specific about the details as to why. And then we get into the Federal Reserve. Everybody watches everything the Fed says. And what we have here is actually a conference that was done where Jerome Powell, Ben Bernanke, and Janet Yellen made a few statements. They were asked questions. And so the media picked up the little sound bites and presented that to the world, and of course the market traded higher on it and will forever be quoting the little pieces of positive news that was coming out of Jerome Powell's mouth. But instead of just taking the sound bites, I actually was listening to this meeting and I took notes during it so that you can get the actual information, not what they want you to hear. So of course I'll bring that to you, but I wanted to go through this quickly first. Stocks rallied Friday after Fed Reserve Chairman Jerome Powell said mild inflation gives the central bank greater flexibility to set policy in the year ahead, and that the Fed wasn't on a fixed path to push its benchmark interest rate higher. They are already at a territory where it's too constrictive. Think about that. The interest rates are historically extremely low, and yet it's already becoming restrictive. The market wants easy money, and this is a very big problem overall. When you see this information, you should be worried, not happy. But of course, that's not how the market works. It's only within one trading session that anybody cares about anything. With the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. We will be prepared to adjust policy quickly and flexibly and use all of our tools to support the economy should that be appropriate. And the market rocketed higher at this point because they took it as there not going to be any more Fed hikes, so we don't have to worry. The market is only going to go higher from here. If it starts to go down, they're going to support us. And you couldn't be more wrong. I'll say it right here. If the market continues to go higher from this point on, you're going to see the Federal Reserve increase interest rates, and that's going to have a downward impact. Then, of course, if the market stays where it is and the Federal Reserve perhaps increases interest rates, going to have a downward impact. If they don't increase interest rates, then the market can perhaps go sideways, up and down, and trade within a range. But either way, without some sort of easy monetary policy, there's no possible way that the market can go higher. Quantitative tightening is destroying these markets, and we've seen that all throughout 2018. There is no denial of that. I'm surprised that the Federal Reserve is still keeping face in such a ridiculous time frame that we've had. They came out and suggested that they resolve the crisis by utilizing quantitative easing, and it is, in fact, a lie. They know that, but here we are today. So I grabbed a couple quotes from this conference that they had, and I wanted to bring them to you. I thought they were important. Powell, referring to the effect of QE policy, he said this, quote, "We didn't see asset bubbles as a result." Now look at real estate. Look at what has happened in some of these cities like Las Vegas, like Seattle, like San Francisco. What happened to those? Is that normal to see that kind of price increase? Money doesn't follow in the direction where they decided to go. When they print up the money, it sloshes around and eventually starts to blow up a bubble. It could be in real estate, it could be in stocks, it could be in bonds, it could be anywhere. There's no possible way to determine where it's going to go. And so we have all these different types of bubbles that have appeared. And this is just one example that I brought up. Bernanke said this, referring to the previous crisis: "We conducted currency swaps with 14 other central banks." Most people, they don't know that. Most people in the financial industry don't know that. In fact, they don't care. But this tells you that they have, in Bernanke's own words, they became, quote, "the global lender of last resort." And that should be worrisome to everybody in the United States as well as other countries around the world. Now think about this. You are in the United States. Your country has a central bank. That central bank decides to do whatever the hell it wants and starts to give money to other institutions all around the world. We found out that there was a $16 trillion bailout to all other institutions around the world. When they were asked, "Tell us who you gave the money to," Ben Bernanke literally said no. Then there was a limited audit of the Fed. That came out. We saw the data. We knew that they were giving money to literally everywhere around the world, including Canadian banks. Basically, all other countries received a massive injection of money. Now, does that make sense when all of these other central banks around the world could print money and they could give it to their own respective countries and institutions? Why is it the case that they became the global lender of last resort? Something is screwed up in this system, and it isn't the way that you are being told in the mainstream media. The mainstream media only gives you the sound bites that they want you to hear. But if you just go one layer deeper, you're going to unfold a lot of detail. And there are more layers to it, but even just one or two layers deep, you're going to get so much good information, I assure you. Janet Yellen said that we need to have more power over the banking system like in other countries. They want to be able to control these systems more so. And that couldn't be a worse idea. Why would you want an institution that has no transparency, no oversight from the people and give them more power? They already issued the currency and give money out to institutions all around the world without approval from anybody, and you're going to give them more power? Well, that's probably not a good idea. And then Janet Yellen said, we're actually worse off now because we lost our emergency powers. That's right. They wouldn't have been able to backstop the losses like AIG, for example, this time around. So they actually admit things in this conference, little bits and pieces that you don't get on the sound bites on the mainstream media, and that's why I bring it to you here. So I hope you do appreciate it. I actually listened to it while preparing this video. I knew that there was going to be some good info, so I started listening to it, taking notes as I did. So there was a lot of other things as well, but this was just a couple that I had recorded. So I wanted you to get that data. And just a little bit more background information. This is the central bank currency swaps of the Federal Reserve. And you could see something interesting. So they engage in all these currency swaps on all these dates, and actually above this on the previous page, there's some more data. But look at this. October 31st, 2013. Participating central banks, same as above. All right. So basically everybody. And then the amount, indefinite amount and term limit, swap as required. Term, permanent. Isn't that interesting? An unlimited lifeline from the Federal Reserve to all central banks across the world. What have they done since? We have no idea. Which central banks have they given money to? We have no idea. How much money have they given since? We have no idea. There are so many questions, and yet all the market cares about is what's happening to my 7 shares of Amazon. This is a very big mistake on the part of the investors and the mainstream media not asking the right questions. But we know money talks. So let's look at this. Previously, we saw the flash crashes that occurred in the currencies around the world. I covered it briefly on the previous video. Wanted to touch on this again. Can you believe it? The yen jumped almost 8% against the Australian dollar to its strongest since 2009 and surged 10% versus the Turkish lira. It took 7 minutes for the yen to surge through levels that have held through almost a decade. Imagine how quickly things are happening today because of computer algorithms. This actually admits it in this Wall Street Journal article, or perhaps this is Bloomberg. Whatever the cause, the moves were exacerbated by algorithmic programs and thin liquidity with Japan on holiday. This could happen at any moment, and yet the market celebrates the activity that takes place on a daily basis. It's so dangerous when the market can go along in normal fashion. It's up and down, and then suddenly it just falls to the floor. And usually it picks up higher and sort of continues a trend, but it doesn't matter because in this period of time, there's a lot of question marks. There's a lot of uncertainty. What will happen to that asset? We don't know. There could be trading that's halted. There could be other triggers that are set off as a result of this. That's the danger with algorithmic trading, and it's becoming more and more prevalent as time goes on. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. So I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these 2 books have everything you need. It gives you all the data from the foundation and the history all the way up until the asset classes, making money, tax incentives. Everything is available in these 2 books. Check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.